IDFC FIRST Bank executed an aggressive structural pivot. It dismantled a legacy infrastructure lending book and restructured itself into a high-velocity, digital-first retail network. The public market values this transition at a market cap of 73,140 crore rupees, with shares currently trading near 84.9 rupees. That valuation is anchored to a specific event, the 2018 merger between Capital First, an agile, high-growth NBFC, and IDFC Bank. Capital First had the technology-driven loan models, but it lacked cheap capital. IDFC Bank provided the commercial banking license required to secure stable, low-cost deposit funding. The resulting architecture is split across three distinct pillars. There is a corporate lending arm managing demand loans and bonds, a retail division handling home, vehicle, and consumer finance, and a specialized SME unit issuing working capital and micro-enterprise loans. IDFC First operates as a hybrid entity. It leverages the growth mechanics of an NBFC while operating within the highly regulated capital structure of a universal bank. The primary engine driving this bank is its retail, agri, and MSME division, known as the RAM book. Their specific advantage lies in proprietary cash flow evaluation algorithms designed to underwrite small businesses that lack traditional collateral. This chart displays the steady upward trajectory of that specific RAM book. Over the last 15 years, management has scaled these loans from just 94 crore rupees to 2.41 lakh crore. This bar chart outlines the corresponding CASA deposit trends. For loan growth to be sustainable, it must be funded by current and savings accounts. The data here confirms they are successfully generating the low-cost liabilities required to fund their asset expansion. Management points to a vast runway ahead. The rapid formalization and digitization of Indian retail credit over the next decade expands the total addressable market well beyond their current market share. Looking forward, internal guidance projects consistent balance sheet and deposit growth, holding steady at near 20% annually for the next 5 years. The market sees that runway and is pricing in flawless execution. To see if the bank actually deserves that premium, we have to look past the top-line growth and run a forensic audit on their actual profitability. There is a severe disconnect inside IDFC First's income statement. The aggressive top-line revenue momentum is masking critical bottom-line inefficiencies. This line chart tracks the bank's total revenue from the fourth quarter of 2024 through the first quarter of 2025. It shows a steady, reliable climb from roughly 9,800 crore to over 11,800 crore rupees. But look at the operating profit margins over that exact same timeframe. They are flat, volatile, and completely divorced from the top-line expansion. The cost of running this digital network is eating the gross yield. This translates into deeply suppressed return metrics. The bank generates a return on equity of exactly 3.78%, and a return on capital employed of just 5.98%. Compare those single-digit returns against their price-to-earnings ratio of 31.7. Investors are paying an elevated multiple for current earnings, banking entirely on the assumption that operational costs will eventually fall and profits will scale. When we verify the quality of the earnings they do have by comparing cash flow from operations against profit after tax, the liquidity health remains intact. The profits are real cash. They are just remarkably thin. The structural issue lies in working capital efficiency. The yield on advances, what they charge borrowers, is high, but it is constantly fighting against the elevated interest rates they must offer depositors to maintain their CASA ratio and prevent asset-liability mismatches. Buyers at the current valuation are paying a steep premium for a high-speed growth engine that has yet to prove it can run with the capital efficiency of a mature Tier 1 bank. If the income statement is inefficient, we have to stress test the balance sheet. We need to determine if that 2.41 lakh crore loan book is structurally sound, or if the low profitability is a symptom of reinvestment rather than failure. This visualization weighs the bank's return on assets against its price-to-book ratio of 1.92. The net interest margins are healthy enough to generate top-line yield, but the ROA struggles under operational drag. We audit customer concentration risk to see where the money is actually deployed. The bank maintains strict diversification limits across its retail, SME, and corporate tranches, preventing any single sector downturn from wiping out their capital. That diversification shows up in the asset quality metrics. The gross non-performing assets stand at less than 2%. After factoring in bad loan provisions, The net NPA drops below 1%. They have adequate cash reserves set aside for the few loans that do default. Leverage is well within regulatory limits. Their capital adequacy ratio proves they are not overextending their equity to fund this aggressive loan growth. The balance sheet is resilient. The low return on equity is a function of the significant operational costs required to build out their branch network and tech stack, not a hidden layer of bad loans. However, a resilient balance sheet cannot protect a stock from systemic operational control failures. The market received a sharp shock when the bank detected a 590 crore rupee fraud. The immediate destruction of trust triggered a precipitous 20% correction in the share price. If their core Moat is a specialized digital evaluation model, the central concern is how nearly 600 crores slipped past those automated risk management protocols. We check the shareholding patterns to measure the institutional reaction. By tracking promoter, foreign institutional, and domestic institutional holdings post-discovery, we can see exactly who absorbed the hit and who immediately liquidated their positions. Crucially, we check for promoter pledging. If insiders had leveraged their own stock, a 20% drop could trigger margin calls and cascade into a broader sell-off. This double bar chart compares the growth rate of external auditor fees against overall profit after tax over the last 5 years. A sharp spike in auditor fees relative to profit often flags rising internal complexity or heightened regulatory friction. We also cross-reference for sudden auditor resignations or prior warnings from the RBI to determine if this fraud was an isolated incident or the result of a decaying compliance culture. Management leans heavily on an image of integrity. They prominently display their ethical, digital, social good branding and consistently highlight their recent green banking and ESG awards. The reality of the 590 crore fraud stands in stark contrast to that carefully cultivated public image. It suggests a severe lapse in basic operational oversight. The balance sheet has the capital buffers to absorb the financial loss. What it cannot absorb is the loss of premium valuation trust. Until risk management is visibly overhauled, the stock remains highly vulnerable to sentiment shocks. This comparative matrix benchmarks IDFC FIRST directly against its Tier 1 and mid-tier private banking peers. By isolating the price-to-book ratio and net interest margins, we see exactly where it sits on the valuation curve relative to competitors with similar books. Fundamentals dictate what a company is worth, but technical analysis shows us exactly how the market is actively repricing that data following the fraud announcement. Looking at this candlestick chart, the short-term breakdown is clear. Price violently sliced through the 20 and 50-day moving averages. Pulling back to map the 150-day average locates long-term support levels where buyers historically defended the stock. We analyze the volume nodes at the bottom of this recent crash. High volume on flat price action indicates that institutional buyers are beginning to absorb the panic selling and step in at these discounted levels. The short-term technical momentum is completely broken. To establish a firm floor and reverse the trend, the bank requires a flawless, zero-surprise earnings report next quarter. This matrix projects 3 distinct valuation scenarios based on the current data. Factoring in management's forward guidance, the elevated PE ratio, and the necessary discount for governance risk, we establish bear, base, and bull target multiples. Mathematically, for the stock to achieve a 15% compounded annual growth rate over the next 5 years, the bank must execute its 20% loan book growth, while simultaneously streamlining its operating costs to drive up net earnings. The investment case presents a direct conflict. Pristine asset quality and a wide retail credit runway fight against severely suppressed return on equity and a damaged governance reputation. Based on the forensic accounting, the technical breakdown, and the fundamental balance sheet data, the risk-to-reward ratio is currently compressed. Our final verdict is a solid hold. IDFC FIRST is a compelling turnaround story currently priced for a level of perfection it has yet to earn. Investors should wait for the return on equity to mathematically catch up to the PE multiple before allocating new capital.